Welcome, everyone, to another episode of Step into the Future of Finance. I'm your host, Michelle Beyo, and I'm excited for today's session where we're really going to explore the pivot because there's a shift happening where the value of money on a global scale is moving from an if to a how when we're talking about this new technology of really diving into the difference between stablecoin and tokenized assets. To give you a sense of the scale that we're going to be discussing, stablecoin transaction volume has grown to 11 trillion in 2025, and the total market cap is now exceeding over 300 billion in early 2026. It is no longer talking about this niche experiment. We're talking about the cornerstone of global financial infrastructures. The industry is currently weighing these two major paths for this programmable money: stablecoins and tokenized deposits. And as we're moving down this path, how is it going to all come together? I am really excited to be joined by Adam Hark, who is the managing director of Wellesley Hill Financial. And I actually met him at Money 2020 Europe only a couple years ago. And it's been such a pleasure to get to know him and his team as they are looking to drive out innovation in M&A and helping companies with growth. So I'd love, Adam, for you to just tell us a little bit about your journey as well as your passion for this topic, and welcome to Step into the Future of Finance.
Thank you, Michelle, as always. And yes, a fateful Money 2020 Europe a few years back that brought us together. By way of background and kind of tracing the how to get from point A to point B, I've always had an interest in economics and finance and technology. And if you were to, draw that Venn diagram, I think financial technology and payments technology kind of lands right in that center where they all overlap. And to be honest with you, around 2006, 2007, when I first got into banking, I kind of accidentally fell into the payments technology space. I didn't know exactly where I wanted to practice, but that's where I landed initially. And it was, I found it, given those interests, just to be a wonderfully complex and fascinating space, just because, prior to that, as a consumer, I think like most people, we really don't think much about payments or the movement of money. We only care that it works, and it works well, and it works fast, and we can trust its delivery from point A to point B and the parties involved. But once you start unpacking or double clicking on the how it works, at first it's almost overwhelming. You think it's kludgy, clunky, perhaps overly complex, more complex than it needs to be. And so that really grabbed my attention. And so that's where I made my home as an investment banker and an advisor. And continuing on today, I think just especially coming out of the pandemic years with this, which really catalyzed digitalization for companies. And the I think you probably remember as well. I mean, there was a point in the pandemic when nobody wanted to even touch physical money anymore. So it really, catalyzed so many different industries, but especially in financial technology. It spurred these new technologies. It spurred investment into these new technologies. And, what we're sitting on and watching today, I mean, not just with financial technology, but with the addition of general purpose technology of artificial intelligence. I mean, we really, really are at an inflection point in time that we will, people in our cohort will look back and say, wow, we lived through that. These little kids who are already using it may not have as vivid a memory of that stark inflection point, but it's fascinating to me what's going on right now with these different technologies and watching how they're evolving so quickly. You and I had talked about doing this podcast for a while. What I would have said 2 weeks ago, literally, I probably already have changed based on the subject matter of today's, just on recent events. I mean, that's how quickly things are moving.
It really is. It's the fastest paced change that I've seen in payments. And I think it's complex because payments are already complex, like you described. If you're in payments, you realize it's just so many different layers, depending if you're speaking consumer payments or business payments or international payments. And then you layer in this new move to start talking about tokenized assets, as well as having stablecoins. And I think for the audience, describing the two of them and the differential between the two and why they're competing, I think is such a crucial way to kick off.
Well, it's interesting that you use the word competing. At a panel I did earlier this week, a question was asked that was similar in nature, and they framed it that way. Is it actually a competition? I think that some of my fellow panelists argued that they saw it a little bit differently. That there are different applications for stablecoin versus tokenized deposits. But what I think what we're really witnessing here is the emergence of the underlying technology, distributed ledger blockchain, is really, it has its legs underneath itself now. Everyone from large global corporates to the global financial system, tier one banks, tier two banks, understand that this technology has a place in the future of money movement and payments, and they're starting to use it. And what we're talking about is different forms that it takes. The stable coin, which typically runs on public blockchain, wallet to wallet, and literally allows someone at point A to send value to someone at point B at the speed of light, almost instantaneous. In some cases atomically. But then, what's emerged, and I think this is the most fascinating part of the stablecoin story. Now, stablecoin is a very sexy topic right now. There are conferences everywhere. Everybody's like, stablecoin, stablecoin. Toward the end of last year, I did a podcast, I think in October, and I was shocked because I had just read about what JP Morgan was doing with JPMD, which was a tokenized deposit. And I couldn't believe that, the story, in my opinion, was very much underplayed, not spoken about. And I thought it was a complete game changer because up until that point, the idea of having a cryptocurrency that was pegged to, in many cases or in most cases, at least the ones that are most accepted, that's Tether and Circle USDC, to the US dollar. That's what everybody was speaking about, the ability to move that. They had addressed the variability or the volatility issue with Bitcoin and other types of coins that really kind of move all over the place and were not a good store of value. And what JP Morgan did, building out its Connexus network, was actually create the same type of mechanics using blockchain. It still was pegged to actually a dollar in a depositor's account, but it had all the protections of the banking system. And I think that's what the real story is right now, as we discuss the difference between stablecoin and tokenized deposits. It's the story is that the technology is very similar, but one comes with all that trust that people had. Not when I say people, consumers, businesses, banks, governments, in traditional banking, versus public blockchains where it's literally the Wild West. To the extent that it's regulated, that's jurisdictional, and there are some that are stronger than others as it relates to governance. So and that's where I think we're really starting to see the traction now, especially with the tokenized deposits, as it pertains initially here to wholesale payments. Very large payments that are made between governments and central banks and involve, treasury management, settlement of trades, swaps, repos. That's what JP Morgan is using it for now. I believe they're up to $5 billion a day that they're moving. Now, that's a drop in the bucket for JP Morgan, but it's not nothing either. So, we're seeing the emergence, and actually we're seeing a divergence in these two types of digital assets. the ones that run on the public blockchains and are the currency, I would argue, of choice of the digital asset slash crypto ecosystem, and these tokenized deposits, which are utilizing that same technology and getting those same benefits of always on immutability, full transparency, auditability, and most importantly, programmability. The information that can be packed into these tokens, it's wild, and it's really interesting watching how things are starting to really move. And we'll get into this, I'm sure, in other parts of this conversation. But I mean, as we discussed in the opening, I mean, things are moving so quickly. It's literally week to week, that news is breaking, and there's some sort of announcement that relates to the evolution of these two types of digital assets.
Yeah, it really is moving so quickly, and I love the passion behind your excitement of what's happening here. Because I think a lot of people are trying to take it in, right? They've heard about stablecoins because, as you said, they're at a lot of conferences and there's a stablecoin panel, but there is not really a tokenized deposit panel that I have seen. It's very quiet, and it's very interesting because there is regulation on the Genius Act describing this whole stablecoin perspective. But I think it's been a little bit more quiet, but yet very powerful to what tokenized deposits could do. And I wanted to get your opinion when looking at settlements for large enterprise, like these giants that have these global settlements. Beyond the math, how do they establish a fundamental trust required for the movement of this value? And do you think it's going to be on stablecoin, or do you think it's going to be on tokenized deposits?
So first of all, I think as it relates to global corporates, I mean, objectively, I think that the technology is better than what exists in the sense of that it's instantaneous. That often settlement are done at the snap of a finger. It's immutable, it's transparent, it's auditable. That's wonderful. And what that does fundamentally, or what that threatens, is the traditional correspondent banking system with all those intermediaries. So it solves a time problem. Wherever there are intermediaries, there are also additional costs. So it solves a cost problem. But practically speaking, there are two issues here, and they both fall under the same category of interoperability problem. There's interoperability issues with the technology because there are a whole bunch of different stablecoins out there. And in order to receive and send, you have to make sure, and it's not just that, there are different blockchains out there. So in order to send and receive, the sender and receiver have to be using the same blockchain, and there has to be some way on the receiving end of converting it into whatever that the receiving party wants, even if it's another conversion last mile into fiat. So, just looking at it objectively, the technology has the capability to replace the existing, correspondent banking network, which largely runs on the SWIFT network. But the other part of interoperability that is an issue is governance and the differences in jurisdiction. And I think that, practically speaking, is largely driving the divergence now today between the two. And I think ultimately it'll drive adoption in the use cases, global corporates and governments included, because what has happened is, I think there's been a major market move over the years. The original dream, if you don't mind me going off on an aside here, the original crypto dream with Bitcoin was, complete anonymity, a very diffuse, very decentralized system, zero governance. Okay, that is not the world we live in. We live in a world where businesses have to trust their partners. They are responsible for KYC and KYB. They're responsible for local and jurisdictional taxing authorities. They're responsible for proper accounting. Okay, so all these things, and when we talk especially about moving money overseas, cross-border, there are differences in these jurisdictions, and I think where things seem to be headed is that by virtue of using or taking advantage of the same technology within the banking system, it solves a lot of these real problems, challenges, as opposed to, just zipping money, overseas wallet to wallet, where it's not being recorded properly, it's not being taxed properly. We don't know who the parties involved are, potentially, who's sending, who's receiving, whether they're legitimate or not. So I think that, at a very high level, people are quick to say, global corporates will be using this, and they will, because again, the technology is better. But will they be using it outside the banking system, or will they be using it inside the banking system? And I think right now is what we're seeing is that lean and that push towards inside the banking system.
Yeah, and I think that makes sense. And it's really not conflicting on an everyday basis. I think to your point, there's kind of a use case for both. And then there is a point where potentially they converge, but more on the internal aspect of banking than the external, because global, like you said, global regulation is very different. So to conform, you're going to have to exit the rail potentially and not use a USDC. When you transfer money to India, you might need to bring it back to a fiat or over to a different digital currency. So I really appreciate that perspective that there's two innovations happening here, and they're similar but different. And they have similar use cases, but still slightly different. Like one's more consumer touch of money, and one is more internal bank. And then it brings me to this discussion. You mentioned J.P. Morgan having their own, tokenized deposits. But what other companies, like PayPal has gone there? Like, how big does a company need to be? And do they need to be a bank in your mind for the trust ratio of having their own tokenized deposit infrastructure?
I think that remains to be seen. I mean, clearly, JP Morgan was kind of the first out of the gate. Swift Network is building their own blockchain to accommodate tokenized deposits. There's another consortium of banks in the U.S., I believe, using the Carry network. These are all layer one, I believe, solutions, so they're not doing off-chain. Um, Again, the beauty, if you will, beauty's in the eyes of the beholder, of course. But I mean, the convenience of using the existing banking system is that they've already had to deal with those jurisdictional differences and compliance issues, and it's already done. Whereas the public blockchains and stablecoin, that's mostly being moved around in the crypto native ecosystem, is kind of like the Wild West. I think there is one thing we haven't talked about, and this could be another 2 hours, is agentic, which is coming up. It's in the offing. I do think there's a very strong argument for like the USDCs, the non-bank stable coins, to be used in agentic, because that programmability is going to be very important, especially in machine-to-machine payments and interactions. They're going to be conditioned. So they'll be looking for that simultaneous or atomic settlement between the purchase of goods and the receipt of value for those goods.
And the audit trail that it then allows to live when you're dealing with agentic payment and agentic finance, for that matter. We're moving so fast that we're not just talking about agentic payments. We're talking about, and I this wasn't part of the prep, but just talking about this Anthropic Plaid deal where they're moving past agentic payments and going to agentic finance, allowing users to really, they just announced it last week, to utilize their data to basically get personalized financial advice. I think we're running faster than the regulations exist, but I think you're right in the sense that there's going to be potentially like that PayPal tokenized deposit play would run better in an e-commerce kind of agentic commerce play.
Yeah,
Um,
and I think that's a very good point. I mean, it's moving so quickly. I think corporates and governments and banks and even businesses like mine, a registered broker dealer, which is highly regulated, we have to err on the side of caution. So we actually have a corporate account with Coinbase in order to accept stablecoin USDC from clients if that's how they would like to pay. Part of our business, being a fintech and payments technology boutique M&A shop and advisory firm, means that we're working with companies like those, and that is their native currency. So we can accept that. But I'll tell you this, the KYB for getting that wallet open, took a very long time. I'll put it that way. I don't want to slander anybody, but and that's a whole other layer. Whether these the stable coin companies, the pure private issuers, like the USDCs and the tethers, have the infrastructure to properly implement compliance and risk procedures that they're going to need to do. And this comes from something that's just 2 weeks old. These are now the Treasury Department, the individual divisions of OFAC and FinCEN, have now put out letters, looking for a response in terms of how they're going to enforce the Genius Act. And what it's looking like is that they're going to hold these private issuers to the same standards as it relates to AML as they do financial institutions. Now, I don't know if that was built into their original business plan. That is infrastructure. There are costs associated with that. There are capabilities associated with that. And this isn't even getting into the argument over the Clarity Act and why it's stalled and the yield issue. I mean, there's just so much going on right now. It's almost insane. And it's very difficult to actually, stay on top of it and even speak intelligently about it. Like I said, I mean, this conversation may be outdated in 2 weeks that we're having right now, but that's the world we live in right now.
I think when we're looking at the Genius Act, because it gave some clarity, but it also, I think when companies touch any organization or any industry that touches money, they need to be compliance first. Because to me, like we've learned from years and years that compliance is definitely a core tenet of dealing with money. And digital identity is not really something coming to North America because they're not into the description of digital identity, but we need to have an authentication infrastructure that validates that the human is the human and it's not a stolen deepfake, to facilitate stablecoin movement, even payment movement, fiat movement, and any of those aspects. So the evolution of how we validate that you are who you say you are, whether that be digital identity or decentralized identity or some way of valid credentials, is so crucial, that I think companies touching payments should have this compliance first stress, regardless of what's written in the Genius Act. But my question to you is, as these private companies pursue potentially their OCC National Trust Charter and Fed oversight, how does this transition into formal regulation bridge the gap between trust for these private stablecoins? And is it the defined path to protecting USDC or US dominance?
I think, they need to work out the business model, but it's a net positive. First of all, I don't think they're going to have a choice. And to be clear, for most federally chartered trusts, I think OCC has primary oversight, not so much the Fed, not necessarily anyways. But again, the OCC department is a division of the Department of Treasury. So is OFAC. So is FinCEN. They're all speaking they're speaking very much in unison, if you will, as it relates to compliance and regulations. And I think that's a boon for these companies because I think that enhances the trust factor, which is really important. It makes them legitimate. And that's why we're seeing this movement. They realize that. That's why they're pushing to get these OCC charters. They want to be legitimized. They want to be on the same footing, or at least similar footing, as traditional finance and the traditional banking system, so they can really compete with them. I mean, at the end of the day, for the consumer, it's wonderful because more competition usually yields greater benefits to the users. But at the same time, I think, again, I go back to that theme where the original dream of cryptocurrency and the Bitcoin libertarian vision, if you will, of complete anonymity, no governance whatsoever, massively distributed networks, is kind of in the rearview mirror. We're seeing permission networks. We're seeing cryptocurrencies or crypto, stablecoin private issuers. They're moving towards regulation. Now, they want the governance. I think they need the governance in order to compete with traditional finance on that trust piece and that compliance piece, so they can actually become a viable alternative to money, to move money and to make payments, between businesses and consumers alike.
It legitimizes them.
Yes.
In a sense, and calling it stablecoin and it running on a stable, almost constant, without the fluctuation, gives that ability to touch blockchain without that concern of volatility that had been in the past. You mentioned that Swift is trying to step into this space because I'm guessing they see some challenges ahead if they don't. It's good to see that innovation move. But I wanted to also ask you about BRICS coin, because there is BRICS countries. They have kind of come together, and just in January alone, they actually created a BRICS coin. And between Russia and India and China, there's movement of a lot of money in less than 3 or 4 months. I just wanted to get your thoughts on that.
Some one final comment on Swift. I mean, Swift is, I think, they're chasing from behind as it relates to establishing their own blockchain that you can run tokenized deposits on. But what Swift has that nobody else has are roughly 11,400, 500 institutions connected to it. So we should keep our eyes on Swift and the development, even though they've been slow to the game. As it relates to the BRICS coin, which is tied to the yuan or the ruble, I don't think has a lot of runway. There are issues with those, anything that's based on the fiat currencies of China and Russia, just by nature or virtue of the types of governments that they operate. You cannot put a lot of trust in them. And so I don't see that as a particular threat. There certainly could be people within that consortium of countries that just want to deal in a closed loop, if you will. But I don't see that as any threat to the dollar. And the interesting side effect, I think, is where you're going with this too, is that one of the fascinating side effects of stablecoin growth and adoption is it's basically been a boon to the U.S. dollar. Whether you want to call it dollar diplomacy, what you see in emerging markets, you see a lot of purchase and holding of U.S. backed stablecoin, which is keeping the dollar strong and maintaining its position as the number one reserve currency on the planet. So I don't see the BRICS coin as a threat for those two reasons. At the same time, you have there are trust issues with some of the countries that participate in that consortium. And at the same time, you have the dollar, which stablecoin has been undoubtedly a boon to.
Yeah, I think the interesting part about the Genius Act is because the USDC is accessible on a global scale, some people are tokenizing their assets against it in different countries because they've never been able to tokenize some of these assets. So it's really bringing in their real world assets into the digital space. And if they're in a country that doesn't have a strong dollar that has global visibility, you're seeing, from what I can see so far, and I might have missed something, many of them are kind of using the stable USDC.
You're correct. I mean, we didn't talk about that earlier on in the conversation, but I mean, U.S. backed stablecoins in emerging economies uh, I mean, are highly desired, sought after, especially economies where they have a banking system that's not high trust. Citizens don't have access to the banking system. With the local currency is subject to fluctuation in value and perhaps, you know, undue inflation. You know, it's in the interest of these people. I mean, provided they can get a wallet and access the blockchain, they can convert value into US DC or Tether, and that provides them with relatively stable currency or store of value. And it's a no-brainer that they'd want to, put whatever money they are working in into the system and change that over, convert that into stablecoin currency. So, I mean, it's a fascinating, I think, phenomenon that is unique to stablecoins' continued adoption, the geopolitical type effects. Because when you do that, especially with the emerging markets or emerging economies, that can have drastic or dramatic effects on their own financial system. The sovereignty of the local currency and the ability of those governments to manage it effectively. It could be very problematic. But the net result is it continues to strengthen the dollar. And tying that back to your BRICS comment or question, I don't see the BRICS coin, which I believe is tied to a basket of currencies of the BRICS countries. I don't see that as a threat.
Yeah, no, I really appreciate you addressing that because I don't think a lot of people know about BRICS, I would say, if they're in the space, but they might not know that they have dropped a coin and had some inner loop transactions between them. So I appreciate the insights. And then before we close out, I'd love to get your just advice to, there's so many people that are listening to this podcast, whether they be in North America or Europe or beyond, and just trying to get their heads around this space, whether they be a business owner or be at a bank. And what do they need to really know about stable coins and how it could help their business or tokenized deposits? Because it's still very complex, Adam. And many people just know things are happening, but they don't know how to touch them, enable them, or make them work for their business.
The first piece of advice I would give anyone, whether they're a consumer or a business, um, uh, is to do your homework. And I don't mean that in a pedantic sense. There are a lot of numbers that get thrown around. I mean, I think you opened up with a couple of numbers. The market cap for stablecoin right now is around 300 billion, I believe you said.
Yeah.
And I think estimates is between like 11 and 14 trillion having moved in volume in 2025. Now, of that amount, the highest estimates are 5% may have been actually used in real economic transactions between businesses, between consumers and businesses. And a lot of organizations and reporting have that number as low as 1%. So the overwhelming bulk of stablecoin movement right now and processing is being done in the crypto native ecosystem. So that's largely with the exchanges moving money back and forth and people and trading settlements. So I don't think people should panic. I don't think there is a reason for the average consumer to need to have stablecoin. Forgive me. And even in the as it relates to tokenized deposits, the volume that JP Morgan's pushing, by way of example right now, that's mostly, if not all, wholesale payments. So those are governments, those are global corporates, those are other financial institutions, very large ticket items. And this is a not nearly as decentralized as perhaps again the original crypto dreamers may have preferred. These are permission blockchains, so you have to go through a rigorous KYB to even participate and have a wallet with JP Morgan to do these types of transactions. So I think the net of it is I don't think there's any reason to panic. I don't think they're missing out on anything at the moment. I don't think there's a real need, especially for consumer or small businesses. Now, I'm speaking to you with that perspective from someone who operates in the US. Now, if I'm a small business in another country right now, I probably would be giddy up about getting a wallet and accessing a public blockchain and seeing if I could sell my wares globally. But that gets into, again, those jurisdictional differences. And so the benefits somewhere else may be entirely different, or the upside may be entirely different than it is here. But there's no rush. There's no reason to panic. I think everybody is in a good place. I'd also be mindful, you mentioned JP Morgan. I think the other company to take a close look at and watch in terms of how this technology is evolving and how adoption is actually increasing is MasterCard. I think they've been at the vanguard of this movement towards digital currency. With their launch, they launched their own multi-token network, which accommodates both stablecoin, traditional, stablecoin and tokenized deposits, and the recent acquisition of BVNK. Although I don't fully understand the inner workings of that data stack of BVNK, it's a key piece, and essentially they're setting themselves up to be true to their word of providing consumers with choice and businesses with choice of payment. They are at the bleeding edge of, and they're not a bank, obviously, but their customers are banks. But they're at the bleeding edge of allowing any type of entity to accept any form of payment in a regulated, highly governed, permissioned way. So keep your eyes on those two. I think they're leading, and we'll see what they come up with as the rest of the year unfurls.
I love that. Thank you for sharing that perspective because I think some people are a little fearful that they might be missing out. But I feel like it's very B2B interbank transactions at the moment. If you're looking at the near horizon, do you see that digging deeper to be a stronger, more than 300 billion, but also still in the interbank B2B play? Or do you see it kind of evolving to also have more consumer visibility as we kind of get past the Clarity Act and the Genius Act and let's say KYC, KYB being mandated?
Well, I think that's that begs the question. I mean, because what you have now is you see that there were issues with the Genius Act. Okay, they can't get the Clarity Act pushed through now because of the yield loophole, if you will, that they left in there, or that was intentionally put in there, that precluded private issuers from sharing yield with people who own or I would say investing in stablecoin is not really a thing. You'd be like investing in dollars, but people who own stablecoin or use it. So, and that's what's holding up the Clarity Act. You're seeing the push now with they're trying to get those OCC national charters. You're seeing the different departments of Treasury weigh in. So you've got this kind of convergence here between the two. I think as it relates to where does this ultimately go, does it trickle down, and is there a consumer use case? Gut tells me that the lean is going to be towards utilizing the technology within the banking system because of that trust factor, except with the one exception, which is agentic. Because I do see a really compelling use case in agentic commerce, again, especially with a bot to bot or machine to machine transaction, the programmability. I can definitely see consumer use case there. If because the bot on the consumer side is going to have access to a smart wallet, where permissions, that's where the consent record will be, intent will be able to be verified. And I think when you think about that smart wallet, it's probable that consumers by then will need to have chosen a certain type of stablecoin or tokenized dollar, we'll say, of preference. and it may also be related to the other side, what the merchant on the other side of that is, will receive or accept, as payment, as it relates to a tokenized dollar, whether they have a preference for USDC or tokenized deposits. So it remains to be seen. But I mean, I think there's a lane for both of them, and but I think it's too far out in the future for it to be a concern for consumers at the moment, and B, still too many questions around it to actually make a prediction.
Thank you so much, Adam. It was such a pleasure to have your insights on this very hot topic that is ever evolving. I think it's really given a grounded perspective to what's happening. And I really appreciate your time and your insights for the audience. Thank you for being here. To the audience, I hope that you guys like and share this. Dig deeper into what's happening by going on to podcasts as well as different webinars, free events, because I think the more knowledge that we have, we can step into the future of finance together. So thank you so much, Adam.
Thank you for having me, Michelle. Really appreciate it.